Sharon. Welcome to this week's edition of MFB News. I hope you're very, very well indeed. Another beautiful grey, cloudy day here in England this morning. My word, I'm not sure about you, but I'm so ready for the spring to turn up. It does feel like we've had a couple of days where you can kind of feel it approaching. So I think we all just want to fast forward to some warmer, drier weather now, don't we? Now, in terms of what we've got for you this week, we're going to be doing our usual roundup in terms of what's been happening with swap rates and lender pricing. Again, a very mixed bag as per the last couple of weeks as well, so things kind of continue on the same vein there. We're then going to be sharing some information with regards to the latest UK's hotspots for buy-to-let property in terms of cities. So for those of you who are thinking about maybe investing this year, and there does seem to be more and more of you coming back into the market after a kind of year-long sabbatical from investing, this could be quite helpful content. And then finally, we're going to be going through this week's question of the week. And to give you a spoiler alert, we're going to be talking about how to finance refurbishment properties. Okay, so kicking things off with swap rates. And if I'm honest with you, no great change since last week. So 2-year swaps as of 11:30 Tuesday evening, 4.409, 1 month ago, 4.165. So month on month, circa 0.3% more expensive. 5 years, exactly the same story actually. So 5 years are at 3.850 and 1 month ago they were at 3.580. So again, 0.3% more expensive. And again, I think the good thing is that things have kind of settled at broadly this level. So we're not seeing these things kind of bouncing around and being very erratic. And this really helps lenders in terms of being able to put together a pricing set or a set of mortgage products for you guys to use. Consistency in pricing is really important for lenders, because if things are kind of yo-yoing all over the place, it makes them really hard to really understand how to price their products in a way which is both A, competitive, and B, isn't going to be loss leading for them. The bad news is that they haven't come down, which is what we've obviously been hoping for. And I think actually while we continue with this kind of geopolitical unrest, particularly around the situation centred on the Red Sea at the moment, we're going to continue to find things feeling very, very uncertain. So I think actually for the time being, in terms of swap rates, I think we kind of just are where we are. Let's give it a few weeks. Obviously, we'll keep you updated on a week-by-week basis. But really, like I say, consistency is a good thing. But what we really need to do is, I guess, really start seeing rates coming back down again to sort of see any tangible changes in mortgage lending pricing. And so what we're going to do now is just run through what's been happening with the lender rates. So in terms of this week, like I say, it has been a bit of a mixed bag. The mortgage works have withdrawn some rates and increased them, but they didn't increase all of their rates. So their pricing is now from 54%. The Coventry reduced all of their buy-to-let rates by up to 0.4%. Kensington have removed all cash back from their mortgage products and also increased rates by up to 0.96%. Lend Invest have increased some of their rates. These are now from 3.79. Just know that these guys, and also with the mortgage works as well, the lower rates have the enormous fees. And the Leeds have reduced their rates by up to 0.5% in the personal space and up to 1.1% in the limited company space. Everybody else has been kind of sitting tight. And again, that's probably going to be largely owing to the fact that cost of funds hasn't really moved in the last week. So I think in terms of really going forwards, if you're thinking about getting a mortgage, and we're having this conversation with people, daily at the moment. So, I'm reading in the press that rates are going to come down. And I think actually a month ago, that was a really viable conversation. At the moment, things aren't looking quite as certain. So I come back to the thing that I know I bang on about all the time, but it really is a very incredibly useful tool for you to have here. If you apply for a mortgage now, you secure a rate. If the lender drops their rates down, you can always ask the lender who you've applied to, as long as you haven't completed on the mortgage, to move your mortgage product to the new lower interest rate. There are some lenders that won't do this. There are some lenders that charge a small administration fee, circa £150, and there are some lenders who will just do it as a matter of course. So when you're looking at mortgage options, it's worth just asking the question about what the lender's policy is on product changes down the line. But as long as you haven't completed, you can, normally speaking, move on to the lower rate with the lender. However, if you apply for a mortgage now, you secure a rate and the lender puts their rates up, they won't then alter your rate upwards. So by applying for a mortgage now and securing a rate, you're essentially buying yourself the worst case scenario in terms of the rates that you can get. And like I said, I think in previous weeks, I have actually done the same thing with one of my mortgages that I have going through with Fleet Mortgages. So I've been able to apply for a mortgage at one rate, they dropped their rates down, so then I moved on to the lower product. And we're doing this for our clients all the time. So just really, really worth keeping in mind. Anytime things get a little bit kind of rocky in terms of lender pricing, locking in something just so you've got a worst case position is always a really good thing to do. Okay, now for those of you who are contemplating an investment this year, an insurance firm called Simply Business have released a report talking about where they've seen the highest level of growth in terms of buy-to-let investment, looking at analysing essentially data from 100,000 landlord insurance policies. So Glasgow is number one in terms of cities for investment. They saw a 12% increase in the number of buy-to-let properties in that city, whilst Nottingham and Leeds have both seen increases of over 8%. Now London, whilst being home to over 40,000 buy-to-let properties, saw the smallest growth in the number of privately let properties of those analysed by the insurer. Interestingly, Edinburgh, the city with the biggest growth in 2022, slipped to 9th place this year, and Leicester experienced a similar drop. Meanwhile, Leeds' position skyrocketed to 3rd place in 2023 after failing to make the top 5 last year. So I think that's a really interesting thing. So actually, it's a curious one. So the top cities from 1 to 10, so starting at number 1, so Glasgow, Nottingham, Leeds, Bristol, Leicester, Manchester, Birmingham, Liverpool, Edinburgh, London. And it's interesting that Glasgow has hit the top spot, because as those of you who invest in Scotland will know, there are some sort of challenges in terms of rental freezes, non-evictions, that kind of stuff, which has caused real uncertainty in the market and caused a lot of investors to kind of withdraw. But the counter to this has meant that because there's less buy-to-let properties, it's really kind of pushed rents up. And so actually some parts of Scotland are seeing an increased number of investors looking to go in there. So I hope that helps for those of you who are thinking about investing this year. Like I say, we're definitely seeing a return to market of people looking to purchase buy-to-let properties. No doubt those of you who are thinking about it are tempted by the lower asking prices and the higher yields and the slightly more comfortable interest rates than we saw maybe this time last year. For question of the week, it's not such much a question that we've been asked directly, but we get seeing an increasing number of people who are certainly looking to acquire properties which require some level of works to them, either to make them lettable or to increase the yield on the property. And there's also a contingent of people who are simply buying property to do up and sell on. So we often ask how we go about financing these types of properties. So really what I'm looking at today for you is properties which you're going to intend to retain them as buy-to-let investments post-works. And essentially there are 3 ways of financing these types of properties, depending on A, what it is you're buying and the condition that it's in, and B, your plans for the property once you've gone through the refurbishment period. So the first kind of most traditional way of financing these types of transactions is a bridging loan. Now, bridging loans have in the past had very, very bad connotations attached to them, which was kind of largely dissipated, but I still know that there's still some people are very nervous about bridging loans, because I think in the past they weren't necessarily the most reputable types of lenders. Now, the very good news is that bridging finance is offered by really good bona fide institutions these days, so people like Shawbrook Bank, Precise Mortgages, Lend Invest. So these are kind of really good high street lenders who are regulated by the FCA and have to behave in a certain kind of way. So the market has become much more professionalised. So with a bridging loan, essentially, as long as the property is kind of standing wind and watertight, then actually, normally speaking, you can get a bridging loan on the property. It doesn't matter if it's not lettable, it doesn't matter what the EPC rating is. So these loans will be essentially there to allow you to acquire the property and cover the period of time it's going to take for you to go in and do the works of the property to get it into a lettable condition, at which point you would then remortgage the property onto a traditional buy-to-let mortgage. Now, one of the things that people really like to do in this situation is they would buy the property for X amount of money, spend money doing refurbishment works, and then look to refinance after the work's completed against the new market value of the property, either higher value, to be able to extract some of the money in which they've invested in the renovations back out. And there's a bit of a misnomer here, because lots of people believe that you can't refinance a property that you have owned for less than 6 months. Now, that is true of some lenders. Some lenders simply will not touch anything you've owned for less than 6 months, but there's lots of lenders who will also lend on a property that you have owned for less than 6 months as well. So it's worth kind of just knowing that that is a possibility. The reality is that actually most refurbishments, while there are some people that can kind of turn these things around in lightning time, most refurbishments tend to take sort of circa 3-4 months anyway. So having the property for 6 months may not be a disaster. So the good thing with bridging is A, that you can acquire property that is either not lettable, doesn't have the right EPC. The second thing is that you can refinance and exit against the market value once you have finished the work. So the downside of using bridging is that A, it's not cheap. The way that we kind of quote bridging rates is a monthly interest rate rather than an annual interest rate. And as a kind of rough guide, you'd be looking at circa 1% per month. There is some kind of variation on this depending on the loan to value, the type of property, your experience of doing these kinds of projects, that kind of thing. Broadly speaking, about 1% per month. Lenders charge on average, a 2% arrangement fee. And for most of the lenders these days, there's no exit fee when you come to redeem the loan. So that's kind of the kind of cost implications of a bridging loan. The other thing to know is that when you refinance and exit onto a traditional mortgage, you are going to pay more valuation fees, more arrangement fees, more legal fees. So it can be quite expensive as well. So it's just kind of worth, if you're looking at doing this, what we tend to do for our clients at MFB is we will give them a quote for the bridging loan to begin with, and also a kind of indicative quote for what it looks like it's going to cost them to come out of that on traditional mortgage. So you can kind of see what your overall costs are. Now, obviously on the kind of exit, we're talking about something that's going to happen in months' time, so that could change, but at least it's good to kind of understand what you could be in for, particularly in terms of fees. The other thing with bridging finance that some people get very, very nervous about is, what if I can't, when it comes to it, exit onto a buy-to-let mortgage, I'm stuck with the bridging loan forever? And that is a real risk. So I think it's very, very important that you get yourselves incredibly comfortable that you're going to be able to exit the bridging loan once you've done the works. Now, normally speaking, we don't struggle with this. The only time we've had any real problems is when, for example, we had the mini budget nightmare and lenders were pulling rates and criteria went a bit crazy in terms of rental calculations. So that was a real outlier in terms of what happens in the market traditionally, but actually just be in the knowledge. But if the market kind of goes haywire for kind of exceptional reasons, that can also impact your ability to be able to exit the bridging loan. So it's not without its risks, but normally, broadly speaking, it tends to work very well. Now, the second option would be a refurbishment mortgage. This is where the lender will essentially take on the property as a standard, in a standard mortgage kind of way, in the knowledge that you are going to be doing some works to the property. So essentially, there are a couple of lenders who will say, well, okay, we know the property isn't lettable in its current condition, but we recognise that you're going to do new kitchen, new bathroom, make some EPC changes to the property. And once you have done that, we will know that the property will be lettable. So we're not going to ask you to do a bridging loan and a refinance. We'll take the property on as it is, on a normal buy-to-let mortgage. And we will kind of put lots of conditions in the mortgage offer that you're going to get these works done within a certain time frame. Now, the benefit of doing this is obviously, first of all, you don't have two sets of finance, so two sets of fees and all the rest of it. And the second thing is you kind of obviate the sort of concerns for how you're going to exit any bridging finance. The downside to doing this way, first of all, can be that you the overall product rate is can be quite expensive. So not as expensive as a bridging loan, but more expensive than a traditional buy-to-let mortgage. So again, this is one of those things that you just need to cost up. So am I better off doing a bridging loan and a refinance, or is it better to kind of just get an all-in-one product? The other thing is that what the lender isn't going to do is offer you more cash once you finish the works. So once you buy the property, if you're taking a 5-year fixed rate, any money that you invest into the project isn't coming back out for the next 5 years. And that really kind of is, generally speaking, the deal breaker actually for people looking at this kind of option, because actually buying the property, doing the works, getting your money back out is a kind of rolling thing. So not being able to access that money for a period of time can really put people off. Now, the third option is actually more of a traditional buy-to-let mortgage. This would probably apply more for people who are buying a buy-to-let property. It's lettable in its current condition, but what they want to do is, in due course, at some point in the future, maybe do a loft conversion. So when the lender takes on the property as it is, it can be rented out from day one, which is generally one of the prerequisites for being able to access a buy-to-let mortgage. But actually, you're going to go through a period of planning applications and all those kinds of things. And then at some point in the future, you're going to maybe add something to the property. Now, here's an important thing. Adding something to the property is not the same as changing the property. So if you're going to buy a property and maybe do a garage conversion or a small side extension or a loft conversion, lenders can get on board with that. If you're going to take the property and turn it from a 2-bedroom terrace house into a 3-bedroom HMO or something like that, to really kind of materially change not only the property but the way that you rent it, that would be a very, very different scenario. But if you are just thinking about kind of adding value down the line, then there's nothing actually wrong with taking a buy-to-let mortgage. That can be done. The lender can kind of get comfortable with this. In terms of loan to values, across all of these options, you're looking at really 75% loan to value. In terms of bridging finance, the lenders can actually go up to 85% loan to value, in some cases even slightly higher, to help you with the cost of doing the renovations. But for anything that's kind of a mortgage, not a bridge, so options 2 and 3 essentially, realistically you're looking at 75% loan to value. So that's kind of how it works in a very brief masterclass. But if you did want to have a chat about any refurbishment projects, what we always say to people is that every project is different and would therefore be most suited to a different kind of finance. So if you have a project in mind, just give us a shout. We can run through the options which would be available to you and cost it up. And then obviously you can go away and do the maths on those numbers and see whether it's something that makes financial sense. And that's us this week. So as always, thank you very much for joining us, and I hope you found that helpful. And if you do have any questions for question of the week, please just leave them in the comments below, and I will absolutely be delighted to answer those for you. So all that's left for me to do is wish you a wonderful week. For those of you who have half-term week looming, my word, it came around quick after Christmas, didn't it? Time flies. And as always, if you have any questions, you know where we are, 0345 345 6788. I will see you at the same time next week, and until then, look after yourselves.